Hello and welcome to this Master Budget session. Now, Master Budget includes the following statements. Got a budgeted income statement and a budgeted statement of financial position. Well, we've got quite a detailed question to look at here, so I'm going to go through the question slowly and mention one or two things. So here we go, the example. A friend of yours, Sarah Carter, has recently decided to leave her job as a designer to start her own business. So she's going to start her own business. She plans to open a custom stationery shop that's going to be called Creative Stationery. That's on the 1st of July 2018. Now, Sarah will invest £15,000 of her savings into the business at the start of the business, as pointed out at the start of the business, and expects to require additional financing in the short term. Now, Sarah has asked you for assistance in preparing the budgeted income statement for the first 6 months of her business and the budgeted statement of financial position as at the 31st December 2018. Now, we've got lots of information that's been provided. So she has provided the following information. Right, the business setup. Non-current assets costing £6,000 will be purchased in July and paid for immediately. So there's no credit terms there, they're paid for immediately. These assets are expected to have an expected useful life of 5 years with no residual value. Remember, residual value is scrap value, so there's no scrap value at the end of the 5 years. So whilst we're on that bit in, if they cost £6,000 and then going to last for 5 years, the depreciation will be 6,000 divided by 5, that's going to be £1,200. And that's for a whole year. So I'll come back to that later on. So remember, this is for one whole complete year. Now, an initial purchase of stationery for the inventory costing £3,000 will be made in July and paid for immediately. Inventory will then be maintained at this level. So that's important. The inventory will be maintained at this level of £3,000. Right, forecast sales now. We've got a forecast sales for July, which is £4,000. August is £5,000. September is £6,000. October is £7,500. November is £8,000. And December is £8,500. So they're the forecast sales, what I expect the sales to be in those 6 months. Now, cost of goods sold. The selling price of goods is fixed at cost price plus 100%. So basically what that means is, let's put it over here, the cost price is basically 100%. And then just above the selling price will then be cost price plus 50%, so that'll be 150%. Now we'll use that later on in the question to work out the cost price. So I'll come back to that later on in the question. That's just a little note for the moment. So let me just highlight that for you. Right, credit terms. Now customers, they get 2 months credit will be offered. So customers, they've got 2 months credit is going to be offered to customers. So in other words, they pay us 2 months after the goods are sold to them. Now suppliers, they get 1 month's credit. It will be received for purchases made after the initial inventory purchase in July. So after the initial purchase of inventory in July, then suppliers will have 1 month's credit. So that's your suppliers. Operating expenses. Monthly operating expenses, for example, rent, utilities, etc., are estimated at £1,200 and will be paid in the month incurred. So that's basically £1,200 per month. So we'll come back to that again later on. Drawings, so that's what the owner takes out of the business for their own personal use. Sarah intends to take drawings of £1,500 per month starting in August. Now, when it says in August there, that's important again. So we'll see that in a few moments. Bank balance. Okay, now the bank balance. The budgeted bank balance at the 31st December 2018 is £6,533 overdrawn. Now, what do we have to do? So the task is, using the information provided, we'll prepare 2 things. First of all, we'll do a budgeted income statement for the 6 months to the 31st December 2018. And secondly, a budgeted statement of financial position as of the 31st December 2018. Right, now, to help you in this question, I've given the templates here for you. Now, you will not be given these templates in the exam, so you will actually have to know what to do and remember the formats. But this is basically a very, very simple income statement. It's got the name of the person, Sarah Carter, name of business, trading as Creative Stationery, It's the budgeted income statement for the 6 months ending the 31st December 2018. Now, revenue, if I go back to the information in the question now, the revenue, we're told what it's going to be. Our forecast sales are there. So what I've just done, a little working out below the question. So go down to the question. So I've just put down the sales, forecast sales for July, August, September, October, November, December. And if you add all of those together, you will get £39,000. So our sales then for the period, the forecast sales, are going to be the £39,000. Now, in these type of questions, you don't have things like purchase returns or sales returns or carriage inwards. So all we're interested in is two columns of this. Now, as I did work that before, my revenue is 150% and my purchases are going to be 100%. So we'll get back to that in a moment. Right, so we go back to the information in the question. Forecast sales we've dealt with. Now, I've got here opening inventory next. So I'm going to be looking for something to do opening inventory now. So you go to point number 1. An initial purchase of stationary inventory costing £3,000 will be made in July and paid for immediately. Inventory will then be maintained at this level. So our opening inventory is going to be £3,000. So opening inventory is £3,000. It says it's going to be maintained at that level. So that means your closing inventory is going to be £3,000 as well. Now we need to work out the purchases figure. So this is basically what we do. We know that the revenue is £39,000 and that represents 150%. To work out the purchases, we need to know what 100% of that amount is. So we just put a little calculation on the right. So we take the 39,000, we divide by 150. Now that will give us what 1% is, but we want 100%, so we then times that by 100. So if I do that calculation now, can we have 39,000 divided by 150 and then times by 100. And we get an amount for purchases of £26,000. So as you know now from your cost of sales, your opening inventory plus our purchases, add them together, gives us 29,000. We deduct the closing inventory, which is £3,000, which gives us cost of sales of £26,000. And then gross profit, gross profit, it's your revenue, take away your cost of sales, and that's going to give us £13,000. Next, we're told in a question, this is in point number 5, we've got monthly operating expenses are estimated at £1,200 and will be paid in the month incurred. So no accruals, no prepayments, are paid each individual month. Now this is for 6 months here. So we're going to have 6 lots of £1,200, and then that's going to be £7,200. Now, if I go back to the beginning of the question, we mentioned earlier on, here we go in point number 1. Non-current assets costing £6,000 will be purchased in July and paid for immediately. So we've got non-current assets, we're going to have to work out the depreciation. And we're told they have a useful life of 5 years and there's no residual value or no scrap value. So to work out the depreciation, it's going to be 6,000 divided by 5. Now be careful with that. So let's go down to see what I've done in the solution. So I've got my 6,000 divided by 5. And that's for a whole year. This statement is just for 6 months. So once 6 months, I divide a whole year by 2. So it's 6,000 divided by 5. When you get your answer, you divide by 2. So it's 6,000 divided by 5, divided by 2, and you'll get depreciation on the non-current assets of £600. Then, as in any other income statement, we total our expenses. So we've got 7,200 plus 600. That comes to 7,800. And to work out a profit for the period, in this case it's for the 6 months, it's our gross profit 13,000. Take away the total expense of 7,800, giving us a profit for the period of £5,200. So that's basically your budgeted income statement for the 6 months ending the 31st December 2018. So you'll see there's not a lot in it. There's only a very, very few categories. But you've got to remember the 150% and 100% calculation. And then when you do your depreciation, You work out a depreciation for the whole year, but in this case, because it's just 6 months, you then divide it by 2. So that's your income statement. And that's a little bit of work instead from our forecast sales. Now we've got to do the budgeted statement of financial position as at the 30th of December 2018. So again, the layout to this is very, very similar to what you know from the past. And in this one, there's less headings than usual. So non-current assets we start off with. We have our non-current assets right at the top. So here they go. And I'm going to have cost, depreciation, and the carrying amount. Now the cost, we were told the cost in the part of the question right near the beginning. So let's go back to near the beginning of the information. Here we go. Non-current assets costing £6,000. Now we've just used it anyway in our depreciation calculation. So the cost is £6,000. So my cost column, I put down £6,000. Depreciation, we just worked out. Now there's no depreciation from the previous period because it's only just started in business. The depreciation for the first 6 months is £600. So that's my accumulated depreciation, £600. So the carrying amount is your cost, take away depreciation, give me £5,400. Now the inventory, that's our closing inventory. Now I've already put it in as £3,000. So just a reminder, we go back to our income statement. The closing inventory was £3,000, and that came from the information in point number 1. Inventory will then be maintained at this level, and the level there we were told was £3,000. So that's where our closing inventory is coming from. Now trade receivables, a little bit of a calculation for this one. So we need to check the terms for our trade receivables, our credit customers. So back to the information. I highlighted this in yellow. Customers, 2 months credit will be offered. In other words, they pay 2 months later. So if I go back down to my sales, here we go. So basically the last 2 months here, November and December, will be paid after December. The November will be paid in January and December will be paid in February. So those 2 months are going to be our trade receivables. We've not received them at the end of December. So I put little brackets there. So it's the 8,000 plus 8,500. That comes to £16,500. So our total current assets are £3,000 inventory, £16,500 trade receivables, gives a total of £19,500. Now trade payables, again, let's check the terms, the credit terms for trade payables. So remember I highlighted this one out, here we go. Suppliers, 1 month's credit will be received for purchases made after the initial inventory purchase in July. Now our purchases, if you go back earlier on, let's find the purchases information. Here we go. The selling price of goods is fixed at the cost price plus 50%. So the selling price is 150%, the cost price is 100%. And we get 1 month's credit. So what we need to do now, we need to go to our sales figure for the end of the period, which will be December 1. So that's the selling price. Now we want to work at the cost price. So again, that's your 150%. So you divide by 150% and times by 100 to get the cost price. So we go down to my little solution here. There you go. That's your December sales, 8,500. To get the cost price, we divide by 150, and then times by 100. Now, when I did this calculation, it comes to a decimal, so I'll round it to the nearest whole number. So let's see what we're going to get then. So it's 8,500 times 100 divided by 150. And it comes to 5,667. So I'm just going to put in my formula for Excel. Now, you don't have to do this in the real life because all of yours is done on paper. See, there you see. It's just 5,667. Okay. Now, the bank overdraft, you could be given a cash budget to do, as well as an income statement or statement of financial position. And your bank overdraft figure or your bank figure, you would find that out from the cash budget. But in this question, we are told what it is. So we go back to the top now. It's near the end of the information. Here we go. 7, bank balance. The budgeted bank balance of the 30th of September 2018 is £6,533 overdrawn. So that's going to be in our current liabilities. So it's 6533. So let me just check I've got the right figure. So 6533. There we go, 6533. So we're all okay now. So now our total current liabilities is the trade payables of 5667 plus the bank overdraft of 6533 gives us a total current liabilities of 12,200. Now we want our net current assets. So we have our current assets, which is 19,500. Take away our current liabilities of 12,200, and that will come to £7,300. And the net assets then is going to be your non-current assets of 5,400 plus your net current assets of 7,300 to give us net assets of £12,700. So that's the top section of the statement of financial position. Now we've got the bit at the bottom now. It's financed by capital. Now we need to know the opening capital. So I'm going to go back to the question to find out what the opening capital is going to be. And be near the top of the information. It's in this section here. Here we go. So Sarah will invest £15,000 of her savings into the business at the start of the business. So she invests at the start of the business. If it's at the start of the business, that's your opening capital. So your opening capital is going to be £15,000. So let's go down to the bottom of the statement of financial position. So opening capital is £15,000. Now the profit for the year I've got here is £5,200. Now that comes directly from my budgeted income statement, £5,200. Now that's added onto your opening capital to give you a total end of £20,200. And then as you all know, you then take away the drawings. Now we've got to be very, very careful on this. Let me go back to the information on the drawings now. Sarah intends to take drawings of £1,500 per month starting in August. So she's starting in August. She's not starting interest in August. Now our budgeted statement of financial position is up to the end of December. So we need to work out how many months is that going to be. So it's going to be August, September, October, November, and December. So it's going to be 5 months. So do not get confused and put 6 months. It's just going to be the 5 months she's taken out drawings. I did it specifically for this question to make sure you understand it. In other questions, it may well be the full 6 months, but here we've just got 5 months at £1,500. So we go down to drawings on my statement of financial position. I've got £1,500 times 5 for 5 months, and that will come to £7,500. Now that's deducted from the 20,200 to give us a final figure at the bottom, which has no name, which is £12,700. And to check that you've got it correct, you match that figure with your net assets, and the two of them, if they're the same, which is in this case they are, it suggests to us that we've got the question correct. It's not a 100% guarantee, but it's more likely than not that the question is correct. If they are different, we will know straight away that there's something wrong. But here we've got them both exactly the same figures, which suggests to us that it is correct. So that's a little example on budgeted income statement and budgeted statement of financial position.